Welcome to the Pro Ticker Deep Dive.
Glad to be here for this one.
Yeah, so imagine trying to value a technology company, right? But instead of looking at, it's the software they sell or the subscriptions they manage, you're valuing them based on the literal gigawatts of electricity that they are legally contracted to consume over the next 3 years.
Right, which is it's wild to even think about.
It is. It's completely bizarre, but that is the entirely unprecedented new reality of the global AI semiconductor market right now in August 2026.
Yeah, it's a complete paradigm shift in how we understand corporate value entirely. We have, an abundance of financial data coming in right now, and the contrast between what the mainstream headlines are saying and the underlying, the physical math of the supply chain, it's striking. We're essentially watching all the old valuation models just break down in real time.
We really are. And we have a deep stack of sources to pull from today to kind of try and understand this shift. We're looking at recent financial reports, earnings transcripts, and some advanced market analysis from Morningstar, Trefis, Investing.com, and Barchart.
Yeah, some heavy hitters.
For sure. And our mission for this deep dive is, it's ambitious. We want to cut through this massive hype surrounding these recent earnings reports, and we are going to try to map out the actual physical mechanics of the AI hardware ecosystem today.
Right, like who actually holds the power?
Exactly. Who holds the power, where the real physical manufacturing bottlenecks are, and, how investors are just completely rewiring the way they value these massive companies.
Because when a sector grows at this kind of velocity, looking backward at historical data, it tells you almost nothing about where a company or even the broader market is going.
Right. Okay, let's unpack this, because to understand where we are going, we have to start with the ultimate catalyst for this entire industry shift, which is Nvidia's second quarter results for fiscal year 2027.
Right.
The numbers they just released are staggering. Nvidia reported $96.2 billion in revenue.
It's hard to even fathom.
It is. That's up 106% year over year. And if you look closely at the segment data, their data center revenue alone hit $89 billion.
Yeah.
It's almost hard to comprehend that scale in physical terms. That represents, hundreds of massive warehouse-sized data centers just being filled with premium silicon.
It does. And the sheer volume is, it's historic. But the context surrounding those numbers is what truly sets the tone for the global supply chain,
Right.
Because it wasn't just the $96 billion that shocked the market. It was the forward guidance.
Oh, right, the guidance.
Yeah, so NVIDIA's CFO, Colette Kress, she guided for 70% revenue growth for fiscal 2028.
70%.
Yeah. And to put how aggressive that is in perspective, the average consensus estimate from Wall Street analysts was sitting all the way down at 44%.
So they completely shattered the most optimistic models.
It did, just blew right past them. And then CEO Jensen Huang stated plainly on the call that demand is running well above their actual ability to supply these chips.
Wow.
They are selling everything Taiwan Semiconductor can possibly fabricate for them, and they just cannot meet the market's appetite.
That's crazy. But, looking through these sources, the detail that jumped out to me wasn't just the sheer volume of the chip sales. It was what Nvidia is doing with this unprecedented mountain of cash.
Investments.
Right, yeah. They reported a $7.8 billion gain on an equity portfolio that includes major stakes in SpaceX, Intel, and CoreWeave.
Mm-hmm.
And then on top of that, there is the massive $12.9 billion acquisition of the AI platform Hugging Face.
Yeah, and that acquisition is a critical pivot point for the industry.
Yeah.
Because NVIDIA is, they're traditionally viewed strictly as a hardware company.
Right, they make the graphics cards.
Exactly, a designer of graphics processing units. But these capital moves signal a much broader, I'd say more aggressive strategy.
Yeah.
Hugging Face is essentially the central nervous system for open source AI.
Okay.
It's the dominant repository where developers go to host models, share machine learning code, collaborate.
Well, the GitHub, but for AI models.
Perfect comparison, yes. And then on the other side, you have CoreWeave, which is a highly specialized cloud infrastructure provider. And they're built specifically from the ground up for GPU workloads, rather than just general enterprise software.
Okay, so we've all heard the tired tech cliche, right, about selling pickaxes during a gold rush.
Sure, yeah.
I want to retire that analogy right now because looking at what Nvidia is doing with this cash, it completely fails to capture reality.
How so?
Well, Nvidia isn't just selling tools anymore. By acquiring Hugging Face, they're essentially buying the literal maps to the gold.
Oh, I see.
And by taking massive equity stakes in specialized infrastructure like CoreWeave, they are buying up the land, building the roads, and owning the mining towns where the workers live. Like, it's total vertical integration of the AI ecosystem.
That framework hits the mark perfectly, yeah.
Yeah.
They are vertically integrating the entire developer experience.
Right.
They don't just want to power the raw compute at the server level. They want to own the software platforms where developers actually build the models, and they want a controlling stake in the specialized data centers where those models are hosted and deployed.
So you're just trapped in their ecosystem.
Exactly. It creates this incredibly sticky ecosystem where once a developer enters, they really never have a technical or financial reason to leave.
Man, that's smart. But NVIDIA's success doesn't exist in a vacuum. I mean, they carry so much gravitational pull that their operational decisions basically dictate the fate of the entire Asian supply chain.
They really do. And the reaction in the Asian markets following this specific NVIDIA report, it illustrates that gravity perfectly. So according to the investing.com analysis, NVIDIA included a very specific, almost quiet warning in their earnings report.
Oh, about the memory costs.
Right. They noted they're facing sharply higher memory costs. And that single detail, it created a literal dividing line in the Asian semiconductor markets.
So on one side of that line, you have the clear winners, right? The memory chip makers. Companies like SK Hynix and Samsung, they saw their stock prices rally hard on this news. And the sources note that SK Hynix is a major supplier of high bandwidth memory, or HBM.
Right.
Why is that specific type of memory so crucial here? Like, why is HBM the thing?
Well, to put it simply, the biggest bottleneck in AI computing right now isn't actually the processing speed of the GPU itself. It is how fast you can feed data into that processor.
Okay, so it's a data delivery problem.
Exactly. Standard memory chips are just too far away and they're too slow. So high bandwidth memory solves this by stacking memory chips on top of each other, kind of like a microscopic skyscraper,
Oh, wow.
and placing them incredibly close to the compute core, but it is incredibly difficult to manufacture.
I can imagine.
And SK Hynix has just mastered that stacking technology.
Hmm.
So when NVIDIA warns of tight memory supply and higher costs, the market translates that as supreme pricing power for SK Hynix.
Right, because they're the ones holding the goods.
Exactly. They have the exact scarce resource NVIDIA desperately needs, so they get to dictate the price.
They hold all the leverage.
Yeah.
But let's look at the other side of that dividing line, because the sources point out that the losers in this scenario were the equipment and testing suppliers.
Right.
Companies like Advantest, which supplies semiconductor testing equipment, or Disco, which makes the tools that physically cut the silicon wafers,
Mhm.
and PowerTech. I mean, their stocks fell following NVIDIA's blowout earnings.
They did.
But wait, let me push back here, because on a fundamental level, that just feels entirely counterintuitive to me.
How do you mean?
Well, if NVIDIA is selling over $89 billion worth of data center chips and demand is outstripping supply, that means they are fabricating and cutting more physical silicon than ever before in human history.
Absolutely.
So if Advantest and Disco are moving, 10 times the volume of testing units and cutting tools, shouldn't that sheer scale easily make up for any minor pricing pressure? Like, why is the market punishing a volume-based business so aggressively?
It's a great question. And it really comes down to the underlying mechanics of profit margins within a constrained supply chain.
Okay.
So you are correct that the sheer volume of chips is rising exponentially. But remember that warning about memory costs skyrocketing.
Right, the SK Hynix HBM stuff.
Right. If NVIDIA has to pay significantly more to SK Hynix for that memory, it directly squeezes NVIDIA's own profit margins because their cost to build the final server rack goes up.
Right, but NVIDIA is making $96 billion. Surely they can absorb a slight margin hit on memory without, destroying their other suppliers.
They could, but they won't. When a giant like NVIDIA sees its margins threatened by one supplier who holds unbreakable leverage like SK Hynix, they balance the books by mercilessly crushing the suppliers who lack leverage.
Oh, wow.
Yeah. So equipment makers like Advantest and Disco, they sell capital equipment. It's a cyclical, kind of lumpy business. The market is looking a few steps ahead here and realizing that NVIDIA and its primary fabricators are going to push back incredibly hard on pricing negotiations with these testing and cutting suppliers.
Because they can.
Because they can.
Mm.
And if those equipment makers are forced to slash their prices just to keep their contracts, well, their margins shrink. And in the semiconductor equipment world, losing profit margin doesn't just mean a bad quarter.
Right.
It means you lose the critical R&D funding required to design the next generation of testing machines. So it's a compounding penalty.
That's
The
brutal.
market isn't just punishing them for a bad quarter, it's anticipating a brutal multi-year margin squeeze.
That is fascinating. So the market is essentially recognizing that, yes, Nvidia's pie is getting massively bigger, but the memory manufacturers are taking such a huge non-negotiable slice of it that the equipment manufacturers are just going to end up starving.
That's exactly it.
Wow. Okay, so we just saw how these equipment makers in Asia are getting squeezed because they lack leverage. But if you want to see what absolute unbreakable leverage actually looks like in the supply chain, you have to look at Europe.
Oh,
We
yes.
have to talk about ASML because if we are talking about physical bottlenecks, ASML is the undisputed king.
They are the foundation of modern computation.
Yeah.
I mean, you literally cannot manufacture a cutting-edge AI chip without their lithography machines.
Right. So let's look at the sheer scale of their dominance. According to the Morningstar report, ASML stock is up 55% in 2026 alone. And analysts just raised their 2028 revenue forecast for the company to an astounding 70 billion euros,
Huge numbers.
bumping the fair value estimate to 1,800 euros per share. And ASML reported that their order intake remains, quote, extremely strong, which prompted them to increase their manufacturing capacity by 30% for both their EUV and DUV lithography machines.
Yeah, the demand is just off the charts.
So for the listener who, isn't a semiconductor engineer, what exactly are EUV and DUV machines, and why is this one Dutch company the only one on Earth who can make them at scale?
Sure, so EUV stands for extreme ultraviolet lithography,
Mm.
and DUV is deep ultraviolet.
Hmm.
The easiest way to think about them is as the world's most complex printing presses.
Printing presses.
Yeah. To make a modern AI chip, you have to print billions of microscopic transistors onto a silicon wafer. And you can't use physical tools for this. The structures are way too small.
Right.
You have to use light.
Use light to carve it.
Exactly. So EUV machines, they use lasers to blast microscopic droplets of molten tin 50,000 times a second just to generate extreme ultraviolet light.
That sounds like science fiction.
It does. And then they bounce that light off the flattest mirrors ever created by humanity to print circuits that are just a few nanometers wide. The engineering required to do this consistently, like millions of times a day without failing, it is so astronomically difficult that ASML is effectively the only company on Earth that has solved the physics at a commercial scale.
That is just mind-blowing. But despite that incredible, physics-defying monopoly, they aren't totally immune to market panic.
No, they're not.
Because the sources highlight a major scare back in July where ASML's stock tumbled 13% over just a few days. And this was driven by reports that a Chinese state-owned company had begun manufacturing its own domestic immersion DUV lithography machines.
Right. The domestic production news.
Yeah. And now, looking at this strictly as a geopolitical supply chain reality, the headlines hit, right? A major global power is making its own lithography machines to bypass export controls. And the market immediately panics and shaves 13% off the market cap of Europe's most valuable technology company.
It just highlights how emotional institutional capital can be when a perceived monopoly faces a headline threat.
Right.
But this is exactly where we have to look past the geopolitical noise and focus on the actual underlying math. Julian Evans-Pritchard, he's the head of China economics at Capital Economics. He provided some incredibly grounding context in that Morningstar report.
What did you say?
Well, he noted that while it is a major milestone for domestic Chinese production, the scale is really what matters here. Capital Economics estimates that this Chinese firm might deliver 5 DUV machines this year and perhaps another 20 in 2027.
Wait, 5 machines this year?
5. Contrast that physical reality with the fact that China currently buys roughly 100 of these machines from ASML every single year just to maintain their current manufacturing capacity.
Wow, okay. That puts the 13% stock drop into such sharp perspective.
Doesn't it?
Yeah. I mean, you have these massive headlines screaming about a threat to the ASML monopoly, and the market instantly hits the sell button. But when you look at the raw mathematical reality, 5 domestic machines versus the 100 machines they still need to buy from ASML, it proves the monopoly is completely secure for the foreseeable future.
Exactly.
I mean, a 5% domestic substitution rate is not going to unseat a giant holding a multi-decade head start in advanced physics.
No, it's not.
Mm-hmm.
And the Morningstar analyst Javier Coronero, he expanded on that point really nicely. He highlighted that the sheer sophistication of ASML's machines is really only half the moat.
What's the other half?
The other half is that global chip fabricators have spent tens of billions of dollars designing their entire factory floors around this specific Dutch technology.
Oh, the integration.
Right. The switching costs to adopt an unproven domestic machine are impossibly high. So ASML's technological lead is secure. The July panic was, entirely driven by headlines, completely disconnected from the actual data.
So we have this landscape, right, where Nvidia is pulling in near 100 billion a quarter. Asian suppliers are fighting a brutal margin war over memory and testing equipment, and a European company holds the ultimate monopoly on the physical printing press for the chips.
That sums it up.
With all these physical and geopolitical supply bottlenecks, how on earth is the broader market figuring out how to value these companies? Because if you look at traditional valuation metrics, they seem completely broken right now.
Oh, they are broken. Traditional metrics absolutely cannot process this level of structural change. To understand the new math of the AI era, the Trefis analysis on Broadcom is incredibly illuminating.
Broadcom.
Yeah, Broadcom represents a completely different way the market is trying to price future value.
Let's dive into Broadcom, ticker AVGO, because the numbers here create what looks like a valuation illusion.
Yeah, it does.
Like, if you look at your portfolio screen right now and pull up Broadcom, they are trading at 46.3 times their trailing earnings. And in traditional finance, a PE ratio of 46 means the stock is historically very expensive. You are paying $46 for every $1 of profit the company made over the last year.
Right. Your instinct as a retail investor might be to run away.
Exactly. But if you look at their forward earnings for 2027, the stock is trading at a much cheaper 17.6 times earnings.
Yeah.
How do we reconcile that massive gap?
Well, what the Trefis analysis points out is a fundamental shift in investor behavior. Institutional investors have completely stopped valuing Broadcom based on its past performance or its trailing earnings. They are entirely what they call pricing the order book.
Pricing the order book. Let's use a non-tech analogy to explain what that actually means.
Okay.
It sounds kind of like evaluating a real estate developer, not by how many houses they built and sold last year, but by looking at the exclusive zoning rights and massive municipal contracts they've legally locked up for the next decade.
That is a perfect parallel. Broadcom expects an astonishing $100 billion in AI semiconductor revenue by 2027.
Wait, 100 billion?
100 billion, yeah. And this isn't vague, optimistic guidance cooked up by an investor relations team. These are locked in, heavily detailed delivery schedules with specific, massive buyers legally attached to them.
The details in these contracts are wild, and they actually bring us back to the hook we opened with.
The gigawatts.
The gigawatts. Because the sources mention very specific metrics. Broadcom has 1.3 contracted gigawatts of power lined up for OpenAI in 2027. They have MTIA X accelerator scheduled for Meta. They have a contract for 5 gigawatts of compute power for a frontier model lab by 2027.
Massive scale.
Wait, let me just pause on that terminology. So investors aren't buying a traditional tech stock based on millions of units sold or recurring software licenses. They are basically trading futures contracts on gigawatts of electrical compute power.
Yes, that is exactly how the industry measures scale now. Broadcom specializes in custom silicon, specifically ASICs and TPUs.
ASICs and TPUs.
Yeah, ASIC stands for Application-Specific Integrated Circuit, and TPU is a tensor processing unit. Rather than making a general-purpose chip like Nvidia does, chip that can do a little bit of everything, Broadcom bakes custom silicon designed to do one specific AI task incredibly well for one specific client.
Okay, that makes sense.
And in the realm of these custom chips, the limiting factor for a buyer like Google or Meta isn't the physical number of chips they can buy. It is the physical amount of data center power those chips will consume.
Right.
So the contracts are literally measured and negotiated in gigawatts of power allocation. When you buy Broadcom stock, you are buying a highly specific confirmed delivery schedule of computational power.
That is genuinely mind-bending. But surely there is a risk there, right? I mean, if the revenue is basically locked in via these massive gigawatt contracts, where is the downside? What could possibly disrupt a $100 billion locked order book?
The hidden risk lies exactly where we founded the Asian supply chain.
Profit margins.
Profit margins. The Trefis report highlights a very specific warning from Broadcom CFO. The custom silicon driving this massive growth, the ASICs and TPUs for giants like Meta and Google, they actually have lower profit margins than Broadcom's traditional AI networking business.
Wait, why are the margins lower? If they are building the most advanced custom tech on the planet, shouldn't they command a premium?
You would think so, but it's because of who they are selling to and what they're building. When you build a completely custom chip from scratch for a giant like Meta or Google, the R&D costs are astronomical.
Right, it's totally bespoke.
Exactly. Furthermore, those mega-cap buyers have massive negotiating leverage. They aren't buying off-the-shelf components. They are co-developing the architecture. And that allows them to negotiate the price down.
Oh, I see.
So the risk for Broadcom investors isn't whether the demand is real, the demand is ironclad. The risk is whether Broadcom's profit margins will hold up as the sheer volume of these lower-margin custom chips explodes.
If the mix shifts too much.
Right. If the product mix shifts too heavily toward these custom TPUs, the overall profitability of the company could take a hit, even as top-line revenue easily clears $100 billion. It is a very delicate high-wire act, balancing sheer volume against shrinking margins.
Which brings us to the ultimate question. So what does this all mean?
Right.
When you pull together Nvidia's massive cash generation and ecosystem buyouts, the Asian supply chain wars over memory and equipment margins, ASML's untouchable physical monopoly, and Broadcom's gigawatt-denominated order books, what is the core lesson here for someone trying to understand the specific technological era?
Well, synthesizing all of these sources reveals three core truths about navigating this specific hypergrowth cycle.
Okay, let's hear them.
First, trailing metrics are practically useless. Looking at a company's past earnings to determine its current value in the AI hardware sector will consistently lead you to the wrong conclusion. You have to price the order book.
Price the order book, right.
Second, geopolitical headlines will often mask mathematical realities. We saw that clearly with ASML. A headline about a Chinese competitor caused a massive panic, but the MAV5 machines versus the required 100 proved the monopoly was entirely secure. You always have to run the math to cut through the fear.
And the third.
Third, and perhaps most importantly, the true health of this industry isn't found in the top-line revenue announcements of giants like Nvidia. It is hidden in the profit margins of the underlying supply chain. Whether it's testing equipment makers in Asia being squeezed by the cost of high-bandwidth memory, or Broadcom balancing lower-margin custom silicon for Meta, margins are where the real story of the ecosystem is written.
Margins are the ultimate truth teller. It is so easy to get blinded by a $96 billion revenue number. But if the cost to generate that revenue is silently eating away at the foundational players in the ecosystem, that is where the cracks will eventually show.
Absolutely.
But I want to leave everyone with one final provocative thought to mull over, something that builds on exactly what we just unpacked regarding Broadcom's order book.
Oh, sure.
Because the Trifist data explicitly noted that future revenue is now being measured in gigawatts of power allocated to these massive AI labs. We have Broadcom literally signing contracts for 1.3 gigawatts here, 5 gigawatts there.
Yeah.
To put that in perspective, a single gigawatt is roughly the power consumption of a mid-sized city.
Right.
If future chip valuations and corporate revenues are literally anchored to consumption contracts measuring in the multiple gigawatts, what happens when the physical global electrical grid simply cannot generate enough power to turn those confirmed orders on?
That's the million-dollar question.
Right. We spend so much time analyzing whether we have enough silicon or enough ASML lithography machines. But maybe the ultimate bottleneck to the AI revolution won't be silicon at all. It might just be the physical limitations of the power grid itself.
It is the hard physical ceiling to all of this digital growth. You can print all the custom silicon you want, but the TPU is essentially an expensive paperweight without the underlying electrical infrastructure to run it.
It is the ultimate physical constraint, and definitely something to keep a very close eye on as we look toward the 2027 and 2028 data center buildouts. See you all in the next ProTicker Deep Dive.